In this final video, we'll continue to talk a little bit about how we can classify stocks or put them into some categories, if you will. We'll also talk a little bit about some international investing. And in the end, we'll talk about some basic strategies about how people in general, how they use common stocks in an investment strategy. So as we go through this, we won't spend a lot of time, but there are things, different types or classifications of stocks. Blue chip stocks are large, well-established companies. We would typically, at a minimum, would consider any stock that's in the Dow Jones Industrial Average, those top 30 companies, those certainly are blue chip stocks. We might extend it as far as, say, maybe the S&P 100 would be a set of blue chip stocks. Again, they're not all alike. Some are income producing, some are more capital producing, but they, in general, since they are bigger, they are typically seen as being less risky than most stocks. So if you want a decent rate of return greater than bonds, and you want a little bit less risk, you need to gravitate towards these blue chip stocks. Income stocks, basically you're investing with income in mind, right? You're looking for companies that have a history of paying dividends. Certainly you would like to see dividends that are increasing over time. Why do companies pay high dividends? Again, we talked about this really very briefly earlier in another video, but essentially, they may be paying higher dividends just because they have limited things for them to invest in themselves. On the other hand, it might be just a distribution of profits that they want to share with their owners. Growth stocks, as the term describes, are really looking for appreciation of price, right? So they're looking for earnings growth above the general market earnings. Typically, they pay very little in dividends. Now, these could be blue chip stocks, but they also could be very speculative or very risky stocks. Again, if you're looking for capital gains and you're willing to bear the risk, these are the types of investments that might encourage you or tickle your fancy, if you will, for you to try to invest in these kinds of stocks. Tech stocks basically invest in technology, right? So they look at computers and software and devices, and they look at services that are provided. Again, there's a wide range of safety here, from very speculative stocks to, on the other side, very big companies that are growth oriented, that are legitimate blue chip kinds of stocks. So a lot of these stocks trade on on the NASDAQ rather than the New York Stock Exchange. And again, since they have this component that could be very small companies, they also, in general, as a group, tend to be a little bit more volatile than some other kinds of categories, if you will. Speculative stocks in general appear just to be stocks that really are looking to grow, right? They seem to be in a position to possibly really take off. So they're very risky. Typically, they're newer kinds of companies. They don't have a sustained track record, as it says, right? Earnings are uncertain or unstable. They usually don't pay anything out in dividends. So these speculative stocks, as it says, are very risky. Cyclical stocks are stocks that typically tend to closely follow the economy. So when the stock market or when the business cycle goes up, these stock prices tend to go up, and vice versa. So if you are looking to manage a portfolio, these are the kinds of stocks that you typically want to manage, because by their definition, their value will change as the economy changes. So as you predict an increasing or a growing economy, you want to be buying these kinds of stocks. And of course, you want to be selling them when you perceive that the marketplace is going to then turn down. Defensive stocks typically don't change much with the economy, right? They're less susceptible to the business cycle. So if you think about some of the industries that, public utilities, grocery stores, beverages, right? The drugstore industry, drugs in general. These are going to be a little bit more less volatile, right? So if you're looking for a place to park your money during a slow time, you might want to move it to these defensive stocks, especially if you're an aggressive kind of investor. You want to stay in the market, but you don't want to take a risk with your speculative types of stocks. We can also look at different kinds of market capitalization. So we refer to large cap, mid cap, and small cap stocks. As you go down in size, you increase risk. So liquidity is an issue, price volatility is an issue, but the potential for higher return then is also greater at the small cap range than it is at the large cap range. So if you're looking for numbers, they typically talk about over 10 billion is a large cap, 2 to 10 billion is a mid cap. Small caps are less than 2 billion in market capitalization. We might even find micro caps. Maybe they say, from 1 to 2 billion small caps and less than a billion in market capitalization could be micro caps. So we can divide it by price. What we recognize is as size changes, risk changes. Just to switch gears a little bit, let's talk briefly about international investing, right? Overall, we find that the United States is a huge piece of the stock market, right? So right now they're saying in 2015, the United States share was about 40%. Now that's down a little bit from 1970. So it's not that there's fewer U.S. stocks, it's just that there's more foreign stocks at work here. And over a long period of time, we've shown U.S. has been unremarkable relative to those other markets. That is, the other marketplaces have seen some very dramatic changes in returns. So there are potentials. There's a potential for some great rate of return when you think about investing in foreign markets. And the United States, as you see down here, has averaged about 9.4%. And there's a whole range of countries that on average have higher rates of return. Now we also have to be concerned about the inflation in those countries. So those countries, some of them have some rather high inflation rates. So in a real sense, we're probably very close. But as far as rates of return are concerned, definitely on the international side, the United States is kind of in the middle of the mix, if you will. So how can you invest in foreign stocks? One of the ways you can do it is by some type of direct investment. Actually go to the Nikkei exchange and buy stocks right from the exchange. There's a great deal of risk involved with this. Logistically, there are many issues. There's red tape. You have to deal with tax issues. Regulatory and accounting standards are going to be different. You have to worry about how currency changes. So if you think about currency, right, how does your return change? Well, the rate of return that you earn is whatever dividend income you earn, plus or minus any capital gains or losses, plus or minus any changes in currency risk or currency exchange. So really, there's two things here. Here's the rate of return you get from the security, and then you also have the rate of return that you recognize or feel from changes in exchange. And we can put this in a bit of a formula, if you will. The total return, right? You have the ending value in the foreign currency plus the dividend divided by the beginning value. Now this is just a holding period return. It's the holding period return in the foreign currency. Now, to get that out of the foreign currency, we need to have the exchange rate at the end divided by the exchange rate at the beginning. So the rate of return, again, is influenced by not just the asset and the investment that you make, but also by the differences in exchange rates. So how can this affect your choices, if you will? A strong US dollar has a negative impact on foreign investments, right? So if the dollar is strong, investing in foreign investments, securities, etc., will typically have negative returns. So if you want a higher return on the foreign side internationally, then you are looking for a time when the United States is experiencing a weaker dollar. So you want the value of both the foreign stock and the foreign currency to go up over your investment horizon, right? We want to see that increase over time. So how do people use common stocks? They use it as a storehouse of value, right? Typically, they're looking for some safety. They might be trying to accumulate capital. So their capital gains and or dividend incomes are going to help them to build their wealth with compound returns. So they might be looking for growth stocks and or income stocks. Typically, if they're looking to accumulate capital, they're looking for a longer term investment horizon. They might also be planning on using stocks as a source of income. So they'll be looking for specific kinds of companies, high yield, good quality income shares. That's what they're looking for. So depending on their goals, right, that's going to depend on their actual strategies. So what strategies do we have? We have a buy and hold strategy. Basic, very conservative. You're going to possibly hold these shares for 10 to 15 years. And the objective essentially is to find a place in a secure investment and you watch it grow. If you're looking for current income, you're obviously looking for companies that have a history of strong dividend yields. These are typically, we're looking for some safety and some stability of this income. So you're looking for some trend in the company's history that lends it to the idea that it will continue with this dividend payment. You might just be looking for quality long-term growth, right? We're going to try to, you might do some significant trading because you want to recognize this growth. So we'll be looking in high quality growth stocks. So this might be mid-cap, what they refer to baby blues or technology stocks. We're going to utilize diversification to help us spread out our risk so that we can we won't be subjected to undue levels of risk. So we're going to be looking for quality, right? The amount of the return we get is more important than the source, right? We need growth. We need to see our wealth increase. Now, aggressive stock management, we're looking for attractive rates of return. We're going to fully manage this portfolio. There could be many, many trades. So there's going to be substantial risks. There'll be a lot of trading costs, be very time consuming. We're going to have to pay very close attention to this. This might be moving in a direction of what we might call day trading almost, where we're really looking to make some aggressive moves and we're looking for stocks that have very large increases in price. So with this idea of speculation and short-term trading, essentially we're looking for capital gains, right? Typically we're going to be concentrating on speculative and or small cap stocks. We might be also interested in some foreign shares, especially if in the emerging markets, but often we're looking for some kind of a big hit, right? It's a stock that nobody else is following. We find something out and we make a trade. Again, as we talked about before, time consumption is huge here. You really have to be paying a very close attention to the daily changes in values of these stocks. And of course, since we're going to be recognizing capital gains, there's going to be some trading. And that trading is going to increase trading costs and taxation. So that's the end of our discussion of the general uses of common stock. In future videos, we'll talk about how we value stock, and we'll also talk about how you analyze companies.